Welcome to This Explainer. Today, we are cracking the code on the bank reconciliation statement, focusing purely on getting that absolute conceptual clarity strictly as per ICAI guidelines. We're skipping the basic theory and diving straight into the practical, logical deduction part of solving these sums. So let's take it nice and slow and figure out how to master this using pure logic instead of just blindly memorizing formulas. Here's a quick look at our agenda. We're going to cover starting balances, master the core logic, break down the plus and minus matrix, do some step-by-step problem solving, uncover unknown differences, and finally wrap up with a quick concept check. Let's jump right into step one, the starting balances, or what I like to call identifying your anchor. Okay, so the absolute first step in any BRS problem is knowing exactly where you're starting. You literally cannot reconcile two books if you haven't established your anchor point, right? As you can see, there are 4 possible starting anchors. A debit balance in the cash book means you have deposits, so that's favorable. But a credit balance in the cash book, that's an unfavorable overdraft. Now look at the pass book, it's the exact mirror image. A credit balance in the pass book is your favorable deposit, while a debit balance is your unfavorable overdraft. You absolutely have to lock these 4 definitions into your brain before you even look at a single number. Moving on to section 2, this is where the magic happens, mastering the core logic with the destination rule. Imagine this, you deposit a check, but it hasn't cleared yet. If your starting point, your anchor, is the cash book, the second you deposited that check, your cash book balance went up. But what about the bank? The pass book is our destination here. Since the check hasn't cleared, the pass book balance is still sitting low. So the core logic is this. To travel from your artificially high cash book balance down to your low pass book destination, you logically have to subtract the amount. Makes sense, right? Now let's look at the exact opposite scenario. You issue a check, but it hasn't been presented. The moment you hand it over, you record it, and your cash book balance goes down. But your supplier hasn't actually gone to the bank yet to cash it. So your passbook, which is your destination, is still riding high. To get to that high destination from your temporarily low cash book anchor, what do you need to do? You've got to add that amount back. See, when you think about it like a journey from anchor to destination, memorizing formulas is totally unnecessary. And that brings us to section 3, the plus and minus matrix. Let's see how our destination rule builds out this comprehensive matrix you'll find in the ICI material. I really don't want you to view this as a table to just blindly memorize. Instead, treat it like a summary of the logic we just walked through. Check out the first column for a favorable debit cash book balance. Just like we deduced, a check deposited but not cleared gets subtracted. A check issued but not presented gets added. Now shift over to the second column for an unfavorable credit cash book balance. Notice how the mathematical signs just flip? Why? Because you're starting from a negative, overdraft position. The true beauty of this matrix is that if you grasp the core logic for a normal, favorable cash book balance, you inherently understand the entire table without having to cram. All right, section 4. Let's put this into practice with step-by-step problem solving using illustration 2. Because theory is really only as good as its application, right? Let's step straight into illustration 2 from the source material to prove that this logic engine actually works flawlessly in the real world. The problem asks us to prepare a bank reconciliation statement for Jindal Offset Limited. The balance as per the cash book is 240,000 rupees. This is a positive debit balance. So this is our anchor. We are starting our journey from the cash book, which means our ultimate destination is the pass book. Here's a first transaction. Checks issued but not presented in the bank amounts to 1,36,000 rupees. Now pause for a second. Apply the logic. You issued the check, which means your cash book balance dropped. But it hasn't been presented yet. The bank literally doesn't know about it. So your passbook destination balance is still sitting up high. To get from your dropped cash book balance all the way up to that high passbook balance, you have to add 1,360,000 rupees. If you logically deduce that, you are perfectly on track. Let's try the next one from the illustration. Checks deposited in bank but not yet cleared amounts to 90,000 rupees. Once again, close your eyes and visualize the books. You deposited it, so your cash book anchor shot up. But wait, it hasn't cleared. The bank hasn't added the funds yet. That means your passbook destination is still low. Therefore, to reach that low destination from your high starting anchor, you must logically subtract 90,000 rupees. See how this works? Step by step, transaction by transaction, the logic holds completely firm. Moving on to section 5, uncovering unknown differences. Okay, So what happens in those tricky edge cases where the specific causes of differences aren't just handed to you in a neat little list? Well, you get to play detective. When causes are unknown, you have to methodically compare the books yourself. Step 1. You compare the debit entries, the receipts of the cash book, with the credit entries of the passbook. Step 2. Compare the credit entries, the payments, of the cash book with the debit entries of the passbook. You literally go through and tick them off one by one. The unticked items, those are your culprits. But here is the absolutely crucial part. Step 4. Always verify if the opening balances of both books match first. If there's a discrepancy right out of the gate, some of those unticked items might actually belong to the previous month's reconciliation. And finally, Section 6, our final concept check. We've covered a ton of ground here, so let's do a rapid-fire review to really solidify your conceptual clarity. Here's your first concept check. True or false? Bank charges charged by the bank should be deducted when preparing a bank reconciliation statement starting from a credit balance of the passbook. Think really carefully about your anchor here. The answer is false. A credit balance in the passbook is a favorable balance. If the bank charged you a fee, they've already reduced this balance. Your cash book, the destination, hasn't recorded this reduction yet, so it's currently higher. To go from your artificially reduced passbook anchor to the higher cash book destination, you must add the bank charges back. Let's try just one more. True or false? Overcasting of the debit side of the cash book is an example of a difference that is due to error. So ask yourself, is this just a timing issue or a pure mistake? The answer is true. Overcasting, which just means totaling a column incorrectly, is a classic accounting error. And remember, as per the rules, you actually have to rectify these kinds of errors in the cash book before you can prepare the final bank reconciliation statement. Let's wrap up with this foundational thought straight from the source material. To reconcile means to identify or find out the difference between two different sources and eliminating that difference. That really is the whole shebang. Always focus on the core logic. Ask yourself, where am I starting? Where is my destination? And did this specific transaction make my balance go up or down? If you can answer those 3 simple questions, you can absolutely tackle any complex sum ICAI throws at you. So the final question I'm leaving you with is this. Are you finally ready to stop memorizing and start deducing? Thanks so much for joining in with this explainer.